Hi everyone, welcome to my new video on investments, and today's topic is on price earnings ratio. It's a very simple formula, that we learn in accounting and finance, especially those students of mine who attend my classes in financial accounting, and you probably have heard of this term. And I feel that to a large extent, the concept of price earnings ratio is not very well understood by accounting students. So that brings me to today's topic. Hi, I'm Rodi Chia, and you're watching this on my YouTube channel. So let's begin. Now, what makes the P/E ratio or the price earnings ratio so important? In fact, if you're an accounting and finance student, you will have come across formulas such as gross profit margin, net profit margin, inventory turnover, and various others. And one of the ratios that are frequently taught is price earnings ratio. But you know what, if you're going to ask any accounting student, there is a very high chance that very few of them are able to explain what's the purpose of a price earnings ratio. So, and yet this is a core formula that is you know taught, covered in most of these accounting and finance programs. So the question here is, do graduates of accounting and finance programs truly appreciate the importance of the P/E ratio? Well, it's a very simple metric that is used in valuation, and to some extent is a benchmark on how the market values a stock. So like basically a price earning ratio gives you a figure that is in terms of times. um, Let me just demonstrate how it works. Take for instance, you have a business A, and this business A generates a profit of $10 per year, while business B generates a profit of $8 a year. Okay, question. Would you invest in business A or business B? Okay, I'll give you a minute to think about the answer. Right, give it a thought. What do you think you would like to invest in? Okay, let me guess. To many of this to many of my students, in fact, they probably have said that business A, that's that, you know, right? But if you're going to consider something a bit deeper, did you just realize something missing? Right? You can't really say which is the business you want to invest in if you have not considered something very important that is called price. If you have not been given the price, how would you be able to determine which is a good investment or otherwise? Okay, so take for instance now, I could tell you the price to purchase business A, right? And I now tell you that to invest in business A, you need to pay 100 to acquire all of A. And then now I'm going to tell you that, with that same 100, you could choose to invest in business B, which gives you $8 profit each year, but you know what? The price is exactly the same. Now, you know what? If you just look at my numbers, A gives you a profit of $10 a year. You have to pay $100 if you wish to purchase the business, versus B, which gives you a profit of $1, but you also have to pay $100 for it. Now, this then is a lot more conclusive as to which should you invest in. Quite obviously, you should invest in A. Why? Because if you apply the price earnings ratio, PE, then A should give you a PE of 10 times. Whereas if you invested in B, or if you plan to invest in B, 100 divided by 1 gives you 100 times PE. Now, did you notice the difference? Yes. If you were to take 100 to invest in a business that generates a dollar profit versus one that generates $10 of profit, do you realize something? If you're to invest in B, you're taking a huge amount of risk because you're paying too much for that business. Versus if you have invested in A, which generates more profit than B, and you could purchase it at the same price, the PE ratio is much lower, right? In fact, to some extent, the PE ratio also tells you about the degree of optimism and confidence in the business outlook. Now, so in this case, would 100 times PE be considered unrealistic, unreasonable? Well, you know what, I'm not saying that it's unreasonable or unrealistic or wrong, but it really depends on the context and the situation, because I have not also told you about something regarding this business A and B. What is that? You know, in coming to a valuation of our own, we make certain assumptions about the business outlook, right? Is A and B the same in terms of business nature and outlook? We can't really tell, because I didn't give you enough details. And in fact, that's the thing that we have to consider in practice. That PE of 20 times may sound realistic if you are looking at retail business, high growth retail business, versus a slow growth business that maybe develops property, right? So a business that's slow growth and is in a business that's rather stagnant will probably have a much lower PE than a fast growing retail business, right? So not just outlook, but also the rate of return and consistency of earnings. So PE ratio tends to be a lot higher when the market and the investors have greater levels of optimism in the business, right? And the assumed PE ratio is often an assumption of yours and perhaps even the markets. And usually when we try to value a business, we try to look at um, a business that is listed in the market and has similar characteristic to the business that you're trying to value. And using the PE ratio of that listed company, we try to use that to help us value that other business we are looking at or assessing. Using PE to value a stock does not account for other elements, especially risk, right? The PE ratio is a very simplistic way to value a stock, but it is not an absolute measure. Uh, but still, by looking at the PE ratio, it immediately gives you a quick preview of whether a stock might be overvalued or otherwise. Obviously, if the PE is like 200 times, it might be indicative of certain problems, like investors are a bit too over optimistic, but it may also be indicative of like investors know certain things like the business outlook. Investors are very optimistic. That may result in a very high PE. So the conclusion, so a rising stock. Now a stock that is appreciating in price um, will tend to have higher PE ratios. And as an analyst, as an investor, as a student, it's important to understand that high PE ratio may mean many things, may be good or may be bad. So uh, you can't really look at PE ratio and say that, oh, that's too high because the other stocks are doing like 10 times and this stock does like 100 times, so it's bad. We really have to look at the underlying of the business in order to come to a conclusion to say that, okay, 20 times is reasonable, or maybe 5 times is reasonable, or maybe 100 times is unrealistic. So yeah, so that brings to conclusion my sharing today on the PE ratio. I hope that this has been informative to those of you who are trying to understand this concept. And meantime, thank you for watching, and you'll be watching this on my YouTube channel.